Hello, everyone. We are covering one of my very favorite accounting topics, which is financial statement analysis. So we've been learning throughout the course how to prepare financial statements. We've kind of learned about the different accounts that go on the different statements. And now we're going to really look at how both internal and external users can use those financial statements and analyze them to make assessments and make better business decisions. Okay, so we're going to talk about some analytical methods, and we're also going to talk about some financial statement ratios. And ratios really focus on the relationship between certain items on the financial statements. So let's dig in. All right. So the basic analytical methods that we're going to be starting with are going to be horizontal analysis, vertical analysis, and common-sized statements. And you'll learn vertical analysis and common-sized statements are very, very closely related. But let's start by talking about horizontal analysis. Sometimes you'll also hear horizontal analysis called trend analysis. Basically, with horizontal analysis, what we're going to do, and this let me start with this because this is going to be important for any sort of financial statement analysis that you're doing. You're always going to need what we call comparative financial statements. Comparative financial statements just means that you have at least 2 years worth of data. And this is pretty simple in the real world because under SEC requirements for companies that are publicly traded have to file their annual reports with the SEC. The SEC requires that financial statements be shown in a comparative format. Companies are required to show at a minimum 2 years worth of information on the balance sheet and 3 years worth of information on the income statement. So I think sometimes when you hear comparative statements, you think, oh no, I'm going to have to dig into last year's stuff. No, you're not. It'll be there on the current year financial statements. The last year amounts will be listed there as well. Okay, so in order to do horizontal analysis, and really, to be honest, you don't necessarily have to have comparative statements to do vertical analysis. Before it to be meaningful, you should probably have comparative statements. All right. So once we have those comparative statements, we are ready to dig in. All right. So horizontal analysis, we are going to be looking at each line item on the financial statements one by one. All right. So we are going to look at each account. We are going to first compute the year-over-year change in the account. That's the increase or decrease. We're going to calculate it in dollars. Then after we've calculated it in dollars, we are going to calculate it as a percentage increase or decrease. Okay? To do this, we are going to take the dollar amount of the increase or decrease, and we are going to divide it by the base year. That's the starting year, the earlier year presented. In most cases, it will be, last year, where, basically take this year's numbers minus last year's numbers. That gives us the amount of the increase or decrease. Then we divide that by last year's balance, and that tells us the percent by which the account increased or decreased. So I think it's a whole lot easier to understand when we look at an example. So let's do that. All right. So here we see a condensed balance sheet. All right. Now, if this were expanded, we would see everything that belongs in current assets like cash and accounts receivable and inventories and all of those things. But this is a condensed version. Either way is fine, regardless of whether it is expanded or condensed. We look at every line item individually. Okay. So in this case, we're in year 6. Last year was year 5. Okay. So the first thing that we do is we say, what is the amount of increase or decrease from year 5 to year 6? Well, for current assets, we went from $533 to $550. That's a $17,000 increase. Now we say, what percentage was that? 17,000 divided by the base year. Remember, the base year is always going to be the earliest year. Okay, so it's going to be the earliest year. So 17,000 divided by 533,000, that is a 3.2% increase. Current assets went up by 3.2%. All right, we'll look at one more. Long-term investments, it's the exact same process, okay? So we take the current year balance minus the prior year balance. In this case, it was a decrease, all right? This account decreased by $82,500. Take that decrease, $82,500, divide it by the base amount, which in this case is the $177,500, and what we see is that account has gone down by 46.5%, okay? And again, we can do that for every line on the balance sheet, and we can do the exact same thing on the income statement. This is a horizontal analysis of the income statement. Again, just do it line by line. And I think that's the most important thing to remember when you're doing a horizontal analysis. Just remember, you're going line by line horizontally, okay? So sales, we calculate the change year over year. Then we take the amount of that change, divide by the base year, and that gives us the percentage change year over year. Okay, now let's talk about vertical analysis. Vertical analysis, and again, it's very, very closely related to common size analysis. In fact, sometimes I will actually use the terms somewhat interchangeably. I will explain to you in just a moment the basic difference, but they are very, very, very similar. Vertical analysis is essentially where we take each financial statement and we show each line item on the financial statement as a component percentage of the statement, okay? Now, as you might imagine, in order to present it as a component percentage, we have to have something on that statement that represents the 100% mark, okay, that represents the whole, all right? On the balance sheet, okay, on the balance sheet, that base number that we use for everything is total assets, okay? Now, as you'll see here, in theory, each liability in stockholders' equity item is stated as a percentage of total liabilities in stockholders' equity. But what do we know based on the accounting equation? Accounting equation says total assets equal total liabilities in stockholders' equity. Therefore, basically those numbers are exactly the same. I think it's a whole lot easier to just remember one number. Just remember, total assets is your number. Every single item on the balance sheet should be shown as a percent of total assets. On the income statement, every single item should be shown as a percentage of sales. Okay, so let's look at an example. All right, this is an example on the balance sheet. All right. So again, total assets is your 100% mark. And again, because total liabilities and stockholders' equity is the exact same amount, that's also 100%. But for each of these balances, okay, current assets, 550, divide by total assets, it's 48.3%. What this tells us is of our total assets, 48.3% of them are current assets. Long-term investments, 95,000 divided by total assets. All right, 8.3%. Long-term investments represent 8.3% of total assets, okay? So every single number is going to be divided by total assets to get the percentage. And then you can do the same thing for prior year. You'll just divide by that year's total assets. But again, every number gets divided by total assets, and that gives you the component percentage. Now, again, when we shift over to the income statement, the sales represent the 100% mark. So every single line item, you're going to take that amount, divide by sales. That amount, divide by sales. That amount, divide by sales. And you keep doing that all the way down, and that will give you your component percentage. Okay, so let's look at how this looks in this vertical analysis format. Okay, we see the amounts, and here we see the percentages. And what this is really helpful for is when we're comparing year-over-year performance, or when we're comparing ourselves against competitors. Okay, for example, let's look at this company here. Okay, All right, let's see what happened year over year from year 5 to year 6. Well, we see that sales went up. Okay, that's a good thing, right? But let's look at what happened to our component percentages. All right, as a percentage of sales, our cost of goods sold went up. It was only 68.3% in year 5. Now it's 69.6%. Okay, so what that tells management is maybe we've got some room for improvement there. Okay, our cost of goods sold this year is a bigger percentage than it was last year. So maybe our production cost went up. Maybe we need to reevaluate our supply chains, whatever the case may be. In this case, okay, here's a good thing. Administrative expenses. In year 5, they were 8.1% of sales. Now we've got them down to 6.9%. That's probably a good thing, right? But this is the type of thing that vertical analysis allows you to do. Okay, now, again, common size is very, very similar. Okay, let's take a look at common size. Okay, common size is essentially the exact same thing, except the numbers are gone. Okay, with the common size analysis, we are only seeing the percentages. Okay, the numbers are not visible at all, but it's essentially the same thing as the vertical analysis. We're just only seeing the percentages rather than seeing the numbers and the percentages. Okay, all right, so that pretty much covers horizontal analysis, vertical analysis, and common size analysis. So now, let's talk about some different ratios. Again, financial ratios focus on the relationships between different accounts on the financial statements, okay? So let's start by talking about some liquidity ratios, all right? Some of the most common liquidity ratios that you're going to see are going to be working capital, current ratio, and quick ratio. Now, they've included accounts receivable and inventory in here as well. And that is significant because those things contribute to our liquidity substantially. Sometimes you will see those also referred to, though, as management efficiency ratios. So that's something to keep in mind, too. But they do certainly contribute to liquidity. All right. So what you'll find is in your book, they give you lots of formulas, and I would say do not worry about memorizing these formulas. Just basically keep them handy, okay? Because it's a lot to remember, but if you just keep these formulas handy, you can use them on your assignments, and you can pretty much quickly calculate any ratio that you need to calculate simply by plugging in the information from the financial statements. For example, working capital is equal to current assets minus current liabilities. Well, current assets and current liabilities are typically shown on the face of the balance sheet. So just look at the balance sheet, grab current assets, grab current liabilities, subtract the two. That's working capital. Okay? Current ratio. Notice it uses the exact same numbers that we used in working capital, but this time instead of using subtraction, we're using division. All right, so this time we're going to take the current assets and divide by the current liabilities. That's going to give us the current ratio. Quick ratio is very similar to the current ratio, except we only use quick assets. So what does that mean, quick assets? Quick assets are generally those that can be converted to cash relatively quickly. All right, what we normally use as quick assets is going to be cash and cash equivalents, accounts receivable, and marketable securities. All right. Now you say, well, what did we leave out? All right, the big guy that we left out there is inventory. All right, because in most cases, we cannot liquidate our inventory super quickly without taking a big loss on it. Okay, so for that reason, we're not going to consider it extremely liquid. Okay, it's not liquid to the degree that cash, receivables, and marketable securities are. Okay, and then you see the formulas for the other ratios here as well. Anytime they're asking for an average, you can just use a simple average. A simple average, for example, if they say average accounts receivable, just take the balance from prior year plus the balance from this year and divide by 2 and use that as your average. If you're actually looking like on a financial website or something like that, a lot of times they'll use a calculation that's a bit more complex. They might use like a weighted average or something like that. But for the purposes of our assignments, you will be just fine using a simple average. So again, if they want the average of an account, just take last year plus this year, then take that sum, divide by 2, and that is your average for that particular account. Solvency ratios are a little bit similar to liquidity ratios, but solvency focuses on long term, okay? When we were looking at liquidity, we were really focusing on a company's ability to pay their current assets with current liabilities. So basically, we're focused on a company being able to satisfy those current liabilities as they become due. Solvency focuses on our ability to meet long-term obligations. All right. So some of the things that we look at for solvency, we are going to look at relationships between assets and liabilities, relationships between liabilities and equity, and also interest expense. All right, so here's some of the formulas that you're going to use for solvency ratios. And again, most of these things you can find right on the face of the financial statements. And again, these formulas are in your book. Don't feel like you have to memorize them because you certainly don't. Just keep these formulas handy and feel free to refer back to them as you need to when you're completing assignments. All right. Now, while liquidity and solvency focused on the balance sheet, profitability focuses on the income statement. And we're basically focusing on a company's ability to generate earnings based on the capital and resources that are invested in the firm. Okay, and you see we've got lots of profitability indicators. Here are the formulas for these indicators. And again, you're going to notice that most of them are driven either by sales or income. Okay, in the case of asset turnover, we're looking at the relationship between sales and our total assets. Return on total assets, we're looking at net income and assets. Return on equity, we're looking at net income and stockholders' equity. Same thing with return on common stockholders' equity. Interestingly, price to earnings ratio, often called the PE ratio. In this one, we actually look at the market price of the common stock. So that means you're going to have to go to a financial website and type it in and see what the stock is trading for at any given moment, and divide that by earnings per share, and that gives us the PE ratio. And it also normally gives us an indication of what investors expect to happen with that stock, whether they feel like that stock is possibly a good investment. Because assuming that we have a relatively efficient capital market, those expectations are somewhat inherent in the market price of the stock. So again, keep these formulas handy and you will be all set and ready to go on your assignments. Last but not least, we'll look just at the basic components of corporate annual reports. Again, companies that are publicly traded, they have to file an annual report with the Securities and Exchange Commission. That report is called a 10-K. If you start looking at 10-Ks, you may initially feel just a little bit overwhelmed, but the great news is that they are all organized essentially the same. And once you get comfortable with the way that they're organized and the way that they flow, it becomes much, much easier to look at them, and most of them flow in a very, very, very similar fashion. But some of the key components, that's where you're going to find MD&A. You're going to find management's discussion and analysis of operations. This gives you a little bit of insight from management's perspective. You are also going to find the audit report, both the report on the fairness of the financial statements and also their report on management's assessment of internal controls, their opinion on that. And then you're also going to find the consolidated financial statements. That's the income statement, statement of equity, balance sheet, and statement of cash flows, followed by the footnote disclosures. And those disclosures typically span a good chunk of the report. And remember, the full disclosure principle, I think that's something that we talked about in week 1. The basic rule of thumb is if it would make a difference, to a well-informed investor, then we need to disclose it. So you're going to find lots of details about those balances that are reported on the consolidated financial statements. So I hope that you guys will enjoy your studies this week. And if you encounter any questions at all, always feel free to reach out to me.